Buy term, invest the difference, or buy life insurance and use it as an investment. You'll find in Canada here, we have two different camps of advisors that seem to be constantly at each other to try and determine which one is best for clients. And in this video, I'm going to go over the buy term, invest the difference strategy, as well as the invest in life insurance strategy, and figure out which one is best for Canadians. So make sure you stick around to the very end, because I'll tell you exactly who it is right for. What's up, guys? For those of you who do not know me, my name is Philip Sutter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. So if that sounds interesting to you, I'll put the link in the description below. But without further ado, let's get right into the video. Okay, let's just start this off, I guess, with a basics of life insurance here in Canada. So really, we have two different types of life insurance. We have term life insurance and we have permanent life insurance. So term life insurance is very easy to understand. You pick a duration, maybe a term 10, a term 20, or a term 30. It's incredibly inexpensive. You essentially pay the premiums during that period. You have the life insurance. If anything were to happen, your beneficiaries would receive a face amount. And at the end of the term, you're usually either going to cancel it, or you could renew it, or the other option is you could convert it into a permanent life insurance policy. Now, permanent life insurance policy, there's two different kinds here. We have whole life insurance and universal life insurance. That's really meant to cover you until the end. Where term life insurance is a what if, permanent life insurance is a when. It's guaranteed to happen and you're buying it for the long term. So what I recommend to most people is permanent life insurance is a good option for people that are looking at estate planning. They're looking at passing something down to the next generation. They're looking at paying taxes upon death, maybe leaving something behind to a charity. However, you'll hear quite often that you should buy a permanent life insurance policy as an investment component, and you can put money into it and you can use it during retirement, and you shouldn't buy term and you should buy permanent life insurance, or you should stay away from it altogether and you should only buy term and you should invest the difference, which is what we're going to get into in this video. So firstly, let's talk about just the basics of how does investing in life insurance work? Isn't life insurance just meant to cover us until we pass away, or if we pass away, and pay out a policy or pay out a face amount? How does it work as an investment? Well, that's a good question. So this is essentially how investing in life insurance works, the basics of it. Now, the principle is that you will buy a policy, and within that policy, there's something known as cash surrender value, or if it's a universal life policy, it's just known as the investment account. And now there are some benefits to this investment account or this cash surrender value. It grows all tax deferred and it's an asset within that account. However, it's difficult to access this asset. It's not like you can just go to the bank and it's an ATM and you can just use it. So I most easily equate it to the equity within your home. Just like you couldn't go out and just use a debit card with your house and just start swiping and buying things, you can't do that with the cash surrender value within a life insurance policy. So what do? Well, you need to get a loan against that value. So there's different ways you can get a loan. You can get a policy loan, which is with the insurance company, or you could get a collateral loan, which is where you essentially pledge that asset to another third-party lending institution. You say, hey, RBC or BMO or Scotiabank, I have this asset. Can you lend me some money based upon this asset? That's what a collateral loan is. Now, here in Canada, we have different tax rules than in the US. In the US, there's no taxable event when you take a policy loan. However, in Canada, you could be taxed on a policy loan. So you might be asking yourself, well, why would anyone take a policy loan then? Wouldn't it make more sense to take a third-party collateral loan? Well, here's the thing. Sometimes third-party collateral loans can be difficult to obtain depending on what the value of your cash surrender value is. If you have a very small value, maybe 10, 20, 30,000, they're not going to be as willing to give you a collateral loan on that policy. So that's where you might need to take a policy loan, which is always going to be guaranteed no matter if your credit is bad or if the policy has very low cash surrender values, they still need to give it to you. However, again, in Canada, it could be taxable. So you're probably wondering, it sounds like there's a lot of strings attached to this. How is this going to work? Is this beneficial? Well, let's get into it. So I'm just going to read off the screen here because I have a bunch of numbers here populated. So let's first get into buy term, invest the difference life insurance strategy. So if we picked, let's just say a 30-year term, we have a 30-year individual, and he needs $500,000 of life insurance for 30 years. So he wants it from 30 until 60. So he goes out and he gets himself, a term 30. He's a male, non-smoker, in good condition. He's healthy. The insurance isn't too much. We're going to be spending, $45 a month on that policy. Now, if we went out and got the equivalent policy in a permanent life insurance policy, a whole life, let's say, for example, then we would be paying $450 per month. So it's actually a 10 times multiple of how much you would be paying. So with essentially the buy term, invest the difference strategy is that they say, okay, well, what's a whole life going to cost and what's term going to cost? If whole life is $450 and term is $45, let's take that difference and let's invest it. So let's actually go through this example. So we're going to be making a savings of $405 per month if we choose to buy the the term and invest that difference. So $405 per month. If we save that every single month for 30 years, we put that into an RRSP. So everything is tax deferred. We're also getting the tax deduction on our income every year, and we're returning 6%. At age 60, we're going to have $394,677. At the end of the day, you're thinking, okay, this is pretty sweet. 400 grand, that's pretty good. Let's look at the whole life now. Well, if we bought that whole life, we would then essentially have paid into that for 20 years, because I did it as a whole life 20 pay, and it's going to be $450 a month. So after 20 years, it's paid off, okay? And here's the thing. So within a whole life policy, there's two different numbers that you need to know about. So the cash surrender value has two components. Number one, they have the guaranteed component. What that means, no matter what happens with the insurance company, no matter what happens with the stock market, no matter what happens if Trump tweets something and everything goes crashing down and Elon Musk flies to Mars, it doesn't matter. The guaranteed amount is what's contractually obligated to give you. That's the first one. The second one is what's known as the non-guaranteed amount based on past dividend scale. So what does that mean? All that means is essentially the past performances of the insurance company are going to dictate. They're going to say, okay, well, the last 50 years or 30 years, we've been able to give returns in this 5 to 6% range or 4% range or whatever it is, okay? And they're say, based on the past, we think we can give you this. And if you ever see an illustration for whole life, you'll see these two different numbers, guaranteed and then non-guaranteed based on past dividend scale. And then you should see, if your advisor is good, a -1 and a -2 table to show you what your whole life would look like if they got that return -1% and if they got that return -2% to stress test this illustration. So if we go to our whole life example, we're going to see now that our non-guaranteed value, this is what they want to give you based on past performance, is going to be $280,406. And our guaranteed amount, that means what's contractually obligated to go to you no matter what happens, is $126,000, okay? Now you're probably looking at this with first impressions saying like, well, whole life really doesn't look that good. If we're comparing the non-guaranteed, the best possible circumstance with whole life, we're going to have, what was it here? Just let me look up the number. $280,000 compared to that to our RSP that we just diligently put it in is going to be $394,000. And again, there's no strings attached to taking money out of your RRSP. Whereas with a whole life, you would have to take a loan and you would have to be paying interest on that loan, whether it's a policy loan or a collateral loan. So on first impressions, you're probably thinking, hey, this doesn't look that great at all. Kind of. Let me get into a few things here. Okay. So number one, we're assuming that we put this into an RRSP and everything was tax deferred. That's the first thing. If your RRSP is already maxed out and you had to put this into a non-registered investment and you were in a high marginal tax rate, life insurance would start to look more attractive. So that's the first one, is we're assuming that we can put this into our RRSP. Now, the second one that we want to look at, we're also assuming that we're not going to have any need for life insurance later on in life. When we turn 60 with the term life insurance, we're going to have our life insurance expire and we're probably going to cancel it because it's going to be expensive at that point. So at that point, we no longer have any life insurance. However, with the whole life strategy, we're going to have $776,000 of face amount at age 70. So again, this is assuming that one, we had the RSP that we could put it in, and two, we had no need for permanent life insurance. Now, the last one that this also assumes is that we're going to be diligently putting income into our RRSP every month. With buy term invest the difference, you need to invest the difference. Okay. If you're not investing the difference, then you're just buying term and spending that money on something else. So one of the arguments of people that are proposing whole life insurance, invest in whole life insurance, is that it's a quote unquote forced savings plan. While this may be true, in some circumstances, it may leverage you, or not leverage you, but put you in a financial strain where you may cancel it later on and lose a lot of those investments and a lot of that income that you put into it. So with that being said, let's look at the 4 variables that you need to manage if you do choose to go the route of investing in life insurance, because there are a lot of things that could go wrong. Now, I talked about the cons of the buy term invest the difference. Now this is going to be the cons of investing in life insurance. Okay. So the number one thing that you need to be aware of is you need to be able to continue to afford the premium. This is really the biggest one. So some of these strategies can be very beneficial. However, if you lapse your policy in year 1 or year 3 or year 5 or year 7 even, you're going to just not have that advantageous of a time. Like you're going to have taxes if you cancel a policy. There's going to be a taxable disposition depending on how much cash surrender value is in there. And you're also just going to lose a lot of your money because in the early years of that policy, there's not a lot of value. It grows in value exponentially over time. And in the beginning, it's very small. So the number one thing you need to consider is if you can't afford this and you have to cancel it, you're probably going to be way worse off than you were before. Whereas with an RSP, if all of a sudden you can't put it into your RSP, that's fine. You could just just wait, take a few months off, and then start contributing the next month. It's no problem. The second thing that you need to manage is the dividend scale, or if you pick a UL, which I have strong opinions about, and if you're interested in that, drop a comment below and ask for my universal life insurance video. However, that's one thing that you need to manage as well, is looking at your dividend scale and how much is it earning. With whole life, I mean, it is very much set it and forget it. You buy the policy, the insurance company makes returns, and they give them back to you at the end of the year. With universal life, it's a lot more complicated, and if you did go that route, you should very actively manage your account, and if you're not, I would say don't go UL, and I have strong opinions about that. Again, if you're interested, drop a comment below. So that's the second thing you need to manage. The third thing that you need to manage is the interest rates on your loan. So if you do choose to go this route and you do start to pull an income from this investment during retirement, you are going to need to either A, pay for this interest rate that you need to pay each and every month, or B, you can do something known as collateralize this interest rate. Well, what does that mean? That means that essentially within your policy, the interest that you should be paying is getting tacked on to your overall bill essentially at death. And then essentially when you pass away, the life insurance that you have is going to pay off your existing loan with all of the interest that was accrued upon it. And that is of course going to reduce your face amount. However, those are the two options that you have. You need to manage those as you move into retirement. And some people are comfortable with leverage. Other people's are not. They just want to say, pay it off. I don't want any interest. I don't want to pay any interest debt or anything like that. I don't care that there's opportunity cost and that's all this stuff. I just don't want this debt on my head. Some people are that way. Other people know that there can be value in borrowing and they say, you know what? It's fine. I'll pay the interest or we'll tack it on and I'll have a reduced face amount upon death. It's fine. Which leads me to the fourth biggest variable that you need to manage is this. Investing in life insurance, while it can be very beneficial, is unfortunately incredibly complicated. There's a lot of things that you need to know. There's a lot of strings attached. It can be very beneficial. It's just a lot. I mean, RRSPs are quite simple. You put it in, you get a tax deduction, it grows tax deferred, and then you take it out. That's it. There's no interest rates. There's no dividend scale. There's no policy loans or collateral loans. There's no taxable disposition. There's no cash rent. None of that. So the fourth variable you need to manage with buying permanent life insurance as an investment is you need to make sure that the advisor that you're buying it from is a long-term advisor. What do I mean by that? I mean that he's going to be there or she's going to be there in 20 or 30 years when you actually need to use this strategy. If you're going to be committing to a 20-year or a 30-year plan that is contingent upon an advisor helping you down this path and managing expectations and managing the loan and managing all the taxable dispositions, if that's the case, you need to make sure that that individual is going to be in the industry for the long run. And here's the thing. If you ask any advisor that's pitching you this strategy, chances are he's probably been in the industry for 1 to 3 years. He's trying to sell some of these strategies and he's probably going to be out in the next 1 to 3 years. I mean, that's just the case. 50% of advisors fail within the first 5 years. So here's the thing. If you want to do this strategy, I'm not against it. I just want it to be carefully done. So make sure that when you talk to the advisor that is recommending this strategy, ask him or ask her, how long have you been in the industry? How successful are you in the industry? Do you plan on being in this long term? What's your long-term goals with this? Are you going to be here in 20 years when I have questions about how I need to leverage this strategy? That's the biggest variable to manage with this type of strategy. So here's the thing. I couldn't include everything in this video because obviously it would get way too long. I made another lengthy video, 40 minutes long, where I actually broke into the numbers and I compared this strategy to a traditional RRSP versus this life insurance strategy. And I broke down all the numbers, what it would look like at death, what it would look like with taxes, what it would look like if we stress tested it. And the most important thing, what does it look like at different tax rates? Because that's really what makes this strategy so beneficial, is the tax rate. For someone that's in a 20 to 30% marginal tax rate, it's not a great strategy. For someone that's already maxed out their RRSPs, maxed out their TFSAs, and they're in a high tax rate, this is where this strategy starts to become very beneficial. However, for the vast majority of Canadians, I think this is not a great strategy. If you haven't already maxed out your RRSP or your TFSA, or you still have high interest debt that you're trying to pay off, I would not look at this strategy. I would wait until you get that taken care of. This is more a very good strategy for higher income earners or that are in that high tax bracket arena. So with all that being said, I hope that you guys enjoyed this video. If you guys have any questions, just drop them in the comments below. And if you guys are enjoying this content, all I ask is you give it a thumbs up and I'll see you guys in the next one.